Good afternoon, everyone. Welcome to our Future of Finance event. Thank you so much for joining us today. This year, we decided to devote our annual Future of Finance event to the world of private wealth management. First, I would like to thank our Atlanta Society of Finance and Investment Professionals, CFA Society Atlanta, our programs committee. Thank you so much for organizing this. And also thank you so much to our Executive Director, Kathy Ford, for working on this and helping with organizing this event. I also want to say thank you to all of our sponsors. Okay, our first speaker today represents CFA Institut. Bob Dannhauser, CFA, is the head of Global Private Wealth Management at CFA Institute. He's based in New York, and he is responsible for strategy and content development for CFA Institute's service to wealth management practitioners. Since joining the CFA Institute in 2007, he has managed the Standards and Practice Group and also was head of Global Capital Markets Policy, including governmental relations effort in Washington and Brussels. And prior to joining CFA Institute, he held multiple client portfolio management and sales and marketing positions with a number of institutional investment management firms. In addition to being CFA charter holder, he also has FRM and KAYAK designations. Thank you so much, Bob, for joining us today.
Well, good afternoon, and thank you very much for allowing me to be part of today's program. It looks like an excellent lineup. I know you're going to enjoy the focus on a number of facets of private wealth management, which is where I spend most of my time thinking about not only the future of finance, but also the current state of finance, and in particular the current state of practice in wealth management. And I have to say it's a tremendous privilege to do that, because I can't think of a better time to be thinking about an industry and a profession that's in a state of change. A lot of external factors coming to bear, technology of course being perhaps the most obvious, but a lot of things happening that have the potential to reshape how clients view our profession and how we view ourselves as practitioners in the coming years. And the planning horizon is not so long. Some really interesting things could happen in just the next couple of years. What I'd like to do in the couple minutes I have with you today is share some insights from a new report that will be forthcoming from our Future of Finance initiative that, while not focusing on wealth management specifically, I think has some pretty interesting insights that are definitely applicable to private wealth management. The Future of Finance initiative at CFA Institute tries to take a forward-looking review and analysis of the trends that will shape our profession, both in the near term as well as the long term. There's been a series of reports that I think have tried to address that in a couple of different ways. A couple of years ago, we issued the Future State of the Investment Profession, which undertook to take scenario analysis, looking at a number of different scenarios born in current conditions, as well as some things that we could reasonably anticipate coming down the pike, to think about the outcomes of the investment profession, and in particular to think about how those outcomes matched with changing societal needs. After that, the investment firm of the future was produced, and I see that we had copies of that available at the registration desk. If you don't have a copy and you'd like one, please do grab it. This focused on how firms themselves would need to change, given some of those dynamics that were identified in the Future State of the Investment Profession report, and indeed the scenario analysis was carried forward to think about how firm dynamics would also change. And now forthcoming, it'll be introduced at the CFA Institute annual conference in a couple of weeks in London, is the investment professional of the future. So focusing on individual practitioners while also considering the context of their employers, but thinking about the skill set, the attitudes, and sort of the trajectory of the skill sets that will be required to be successful in a number of roles across the investment management profession, including that of private wealth manager. When I go around the country and talk to people about wealth management, I don't get much pushback about the idea that change is coming. But I do get some different reactions and different perspectives about what change will look like. What you see here is one, what I would say is less common, but still fairly widely held belief that dramatic change is coming and it will upend everything that we know about the way we do business. And I think the most common narrative for this kind of scenario is the Googles of the world, the Amazons of the world haven't touched our corner of the industry yet. But when they do, it will be a dramatic reshaping of client expectations, fees and profit margins, and pretty much every aspect of what we do on behalf of clients. And the more pessimistic view of this rather dramatic, disruptive change is that people like us will have a diminished role in managing the wealth of wealthy individuals, particularly in North America. Another view of change is the proverbial frog in the pot of water where the heat is growing and the frog isn't terribly aware that pretty soon it'll be boiling and that'll be game over for the frog. And in this narrative, the wealth manager is dimly aware of things changing in our environment, but isn't mounting an adequate defense or an adequate coping mechanism, or in its most positive view, a proactive approach to harnessing that change and reinforcing their role as a wealth manager going forward. And while I think this is more commonly held, I would say that the wealth managers I speak with in my travels don't have a particularly well-defined point of view about how to jump out of the pot, how to alter the circumstances or make the changing circumstances work for them and reinforce the value that they bring to the table for their clients. And indeed, I think this is part of the responsibility of CFA Institute, is to help practitioners not only understand what's changing in the world, but to provide resources, perhaps different kinds of resources than we have in the past, to make sure that you are adequately prepared to make the most of changing circumstances, and most importantly, to deliver real value to your clients going forward. So I want to chat just a little bit about two aspects of that change and how CFA Institute might react. And again, I'm drawing on this new report, The Investment Professional of the Future. One of the things that we asked was, what disruption or factor has the most potential to introduce change to a wide variety of roles in the investment profession, again, including private wealth management, but not specifically on wealth management. And we asked this question of a couple of thousand CFA Institute practitioners, CFA Institute candidates, a series of interviews with industry leaders, roundtables, as well as surveys to notables in the industry. And the top-ranked factor that came back, you see before you here, the growth of machine learning, AI, and use of alternative data for portfolio construction. So sort of the fintechization, if you will, of the investment management profession. This was the top-ranked response of all the respondents. It actually was the second highest ranked in the Americas. And we'll talk about what came out on top in just a sec. But it's a fairly consistent response across the globe that tech is here to stay and is going to change the way we do what we do on behalf of clients. Now, you've probably seen press reports that we've observed this trend and have tried to incorporate more in the way we present curriculum to our candidates. So there are now elements of AI and machine learning that are finding their way into the curriculum. Honestly, it's a very, very nominal treatment of the topic, which it's not surprising given the depth of the potential to explore this area. But it's something that we're paying attention to and that we'll no doubt be devoting more time and attention to in the future. And of course, you know how it works with the curriculum. For everything that goes in, something has to come out to kind of make room for these issues. And so that's part of the process now, is to think about what in the curriculum is outdated or can be de-emphasized in favor of some of these newer trends. we did some market research last year where we talked to North American wealth managers, both CFA practitioners and non-CFA practitioners. And we tried to explore a number of dimensions. A lot of this was to inform the brand campaign that I hope that you have noticed that launched in March, that tries to identify the key differences of a CFA wealth management practitioner directly addressed to high net worth investors themselves. But one of the sort of secondary indicators that came out was exploring how practitioners think about technology and the impact on their business. What we did is we asked about a number of services that are typical of a sort of a fully formed wealth management offering. You see those listed on the left-hand side of this slide. And then we asked which of three categories the potential effect of technology would be in the view of each of these practitioners. So would the attribute or the service be completely displaced by technology? Would there be a role for humans, but they would leverage technology to somehow improve that service or at least change the essential character of it? Or would, in fact, it be not impacted by technology at all? And what jumped out at me when we looked at the data was the non-CFA practitioners, which are represented by the sort of rusty reddish-brown check marks. They all sort of tend to clump over on that not impacted by technology column. Whereas CFA practitioners, the blue check marks, either viewed that there was an opportunity to graft technology onto what they're already doing for clients, with sort of a people plus strategy of enhancing their services with the smart use of technology, or potentially that technology would completely displace humans. And in particular for CFA respondents, that seemed like a fairly likely prospect for, you see towards the bottom, providing guidance on how to manage passive investments. So sort of the classic state of robo as we know it today. We'll talk more about that later on in the program this afternoon, but that seems to be sort of the classic business model right now of robos. And so I was left to wonder, why do CFA practitioners take sort of a more optimistic and perhaps realistic view of how technology is going to change their business? And I'm sorry to say that I haven't come up with a great explanation for why non-CFA practitioners take such a different view of the world, other than to suggest perhaps that it's the non-CFA practitioners who haven't developed a value proposition to the marketplace that goes beyond personality and relationship management and some of the behavioral aspects of coaching clients to save themselves from their worst instincts. And that in itself is not a particularly bad value proposition. It's certainly necessary in working with wealthy individuals. But I think what the CFA responses here would suggest is that it's likely not to be fully adequate to be successful both on behalf of clients and as a practitioner going forward. And so I take some comfort that CFAs seem to have a slightly more realistic view of the environment and the changing environment around them. So I mentioned there were two factors that I wanted to focus on. The first of technology, AI and machine learning. The second has to do with growing appetite for solutions investing and integrating client needs. And in fact, that was the top ranked response for the Americas respondents and all that work that the Future of Finance research team did, but ranked second highest by just a couple of percentage points when you look at all the global data. And indeed, that's really at the heart of wealth management, right? Wealth management is typically far more bespoke than institutional investment management. It reflects a number of both qualitative and quantitative concerns of clients. And I think the merger of these 2 points describes a likely path for the future for wealth managers. So the ability to harness the power of technology to scrape data, shape that data, and make it useful not only in the client counseling process, but indeed to clients themselves to help them make better sense of their wealth, their stewardship of their wealth, and connecting their wealth to their achievement of their most ambitious goals. That also requires, in our mind, a more disciplined approach to the soft skills that go into wealth management. So being able to talk about data, apply technology, combining that with the technical expertise that practitioners already have around capital markets and the drivers of value in markets, and have that result in a coherent, compelling conversation with clients is something that we think is worthy of thinking about beyond just what people bring to the table as their innate abilities. So it's already sort of clear that people who are good at creating those kinds of conversations, developing relationships that ultimately are productive, do well in this business, but we'd like to think that there's an opportunity to optimize those skills, perhaps in a very CFA-like way. I'm not going to do level 4 of the exam that'll focus on this stuff. If there's candidates who are studying for the exams now, we're not going to take out all the accounting and substitute it with soft skills or emotional intelligence skills. But perhaps as, that's a very tempting process, isn't it? Perhaps as a feature of our continuing professional development, we're interested in exploring the idea of providing our members with an assessment mechanism, as well as, again, a very evidence-based approach to optimizing the skills that people bring to the table so that they can make the absolute most of their innate abilities. As part of the survey work that went into the investment professional of the future, we asked how likely it was that individual roles would be changing in the next 5 to 10 years. And wealth managers came in second in terms of the highest number of people who said that the role would be substantially different in the next 5 to 10 years. The only role that exceeded wealth management in that category was IT, which is not particularly surprising. And again, I think that reflects the notion of thoughtful people that there's an awful lot in play in wealth management. So it's not just changes in markets, but it's changes in availability of services and products to wealthy individuals, the user experience that they not only have access to, but increasingly come to expect, and the price that they're willing to pay for professional judgment and expert services to help them manage their wealth. And so indeed, that's perhaps not too surprising that a majority of the respondents see substantial change ahead for the role. 4% responded to that same question and saying that the role won't exist, that will all disappear. And I'm gratified, as you might expect, if you're at CFA Institute, you don't particularly embrace the news that human advisors have a dim future. The fact that only 4% could imagine such a future, I think, is instructive. There is continuing value for human advisors to do all the things that machines, at least today, can't do. Things like provide an empathetic response, things like develop trust with a client, things like reading emotion and translating that in an effective way so that clients are not their own worst enemies and in fact can be the most productive that they can be with the wealth that they've worked hard to accumulate. And so there's a lot of really interesting things going on in the business. As I suggested, look for some interesting new things, I hope, from CFA Institute in the relatively near future. We're working on thinking about emotional intelligence skills, as I say, in a sort of evidence-based, disciplined way. We hope to recommend to our leadership team and the Board of Governors by late this summer an approach to that, because there's a couple of different ways that we could go, whether we develop the skills internally at CFA Institute to deliver that kind of resource to our members, or partner with acknowledged experts who are already out there, or do something else altogether. It's a fertile area of exploration for us, and I hope that you as our members will see the results of that in the relatively short term, because we think it's essential to your potential success in the next 5 to 10 years. It will make all the difference in your effectiveness and your ability to differentiate yourselves in what's becoming a crowded, dynamic marketplace. We've got a great agenda for the rest of the day. We're going to be talking about some of these issues and trends, as well as some more things of immediate interest. As I say, I really do appreciate the opportunity to be with you. I'll be here all afternoon, so if there's questions I can answer or anything I can address about what's going on at CFA Institute, please do grab me. Thank you very much.
And now we would like to invite a representative from our sponsor, Voya. So we would like to invite Brett Cornwell, CFA. He is a fixed income client portfolio manager at Voya. And prior to joining the firm, he was the head of fixed income research at Callan Associates. And before that, he was a senior research analyst at Weatherby Asset Management, where he was responsible for all fixed income investment manager due diligence and fixed income asset class coverage. He began his career in 1998 at Morgan Stanley Dean Witter. He received his bachelor's in commerce and business administration from University of Alabama, and he is a chartered financial analyst.
Thank you very much. Wow, good afternoon. Hello. Thank you so much for coming today. It's a pleasure for me to be up here this afternoon. When I heard about the topic of the conference, the future of finance, at first I thought, what on earth am I going to talk about? I'm glad the speaker before me had some actual insight into the future. But what I am prepared to talk to you about today is a little bit about what Voya's economic outlook is, at least in the immediate future. So with that, I'll jump right in. I think I have about 5 to 10 minutes. I think I have more slides than I can touch on, so I might move quickly, but I wanted to hit some of the highlights on what we're seeing in the economy and how that's translating into what we're seeing within the bond markets. So with that, we'll just jump right in. So oftentimes, I get asked, what is our view on interest rates? And that's a really difficult question to answer, because I don't think anyone actually knows what direction rates are going. But the way we like to think about the interest rate environment and frame this discussion is to think about Fed hiking cycles. And in fact, if you've listened to any of our quarterly update calls over the last few quarters, you've probably heard us talking about this, but the 10-year Treasury yield is pretty good indicator historically of where Fed funds rates usually end at the end of a hiking cycle. So whether you're looking back at 93, 94, 2000, 2001, 04 to 06, what you'll observe is generally the Fed funds rate inches right up to where the 10-year Treasury yield is, or sometimes slightly higher, and then that ends the Fed hiking cycle. So interestingly, if you were to look at the panel behind me, this most recent Fed hiking cycle started in December 2015, and we show that in the gray line on the bottom, and then we show the 10-year Treasury yield in the blue line. Over this period, it peaked at 326 late last year before ending the quarter right at 234, 235. And what you'll notice is with the Fed funds rate at 250, what we would argue is that what is the market actually signaling? We're signaling if the 10-year is below Fed funds rate, perhaps the market is expecting the next move from the Fed to be a cut rather than the hike. We actually would disagree with that. We think the market's gotten a little bit ahead of itself in terms of predicting a rate cut in this environment. But we do think it's right to point out, I think a lot of what these rate cut expectations are hinged upon is the strength of the economy. So with that in mind, I thought I would just take just a brief tour about Recession Watch. Now there's a lot of factors that we watch when we're looking for signals of a potential weakness in the economy or the economy rolling over or showing signs of weakness. There's a variety of them. I'm sure you're all aware of the shape of the yield curve. Certainly that's been a popular topic of conversation that a lot of folks have put forth and submitted that would be the indicator that a recession is coming. We also like to look at earnings growth and corporate profits as a percent of nominal GDP. We look at things like corporate credit markets, which we're going to touch on in just a moment. We also look domestically at PMIs, which we think is a pretty good leading indicator of economic activity. But that's all domestically focused, and suffice to say that there's a lot of factors domestically that we would argue aren't really signaling recession. And that's one of the reasons why we think the market's gotten a little bit ahead of itself in pricing the next move by the Fed being a cut. Especially if, if you think about this morning, when you look at the report that came out just in terms of retail sales, strongest number since 2017. You look at the job report, the initial jobless claims, the lowest since 1969. So I'm here to tell you the labor market is alive, and we're going to touch on that in a moment as well. So what we would characterize this as really a bit more like a mid-cycle recession as opposed to an imminent recession, right around the corner. And we say mid-cycle, and I recognize that we're more than 10 years since the financial crisis. But if you look at when credit started actually expanding, we're only about 6 or 7 years into the true credit expansion that we're seeing today, which is why we say mid-cycle. But we're seeing a lot of signals domestically that really warrant, yes, there's been some weakness, and yes, we have seen some softness and slowdown, but in the grand scheme of things, we think the economy is a little bit stronger than a lot of people are willing to give it credit for right now. So with that, one of the things that we are watching, so instead of focusing on all of the things that we think is positive, sure, there are some signs of weakness. And so if we broaden the scope and look outside of the domestic economy and we look a little bit more globally, what I have behind me here are global PMIs. We have on the left panel the manufacturing PMIs. The gray line represents the US, and you can see clearly that that has started to soften just a little bit, but it's not weak in our opinion. We're still over 50. So anything over 50 really represents an expansionary economy. Anything under 50 is more contractionary. But what we have been watching and what we are concerned about is really what's going on in other parts of the world and whether or not that actually starts to pull down some of the growth expectations here domestically. And so you can see the yellow line represents the Eurozone. A subset of the Eurozone we have in blue up there, that's Germany. Those numbers actually have fallen off of a cliff. In fact, Germany is a very manufacturing, export-heavy economy, so it's no surprise given some of the things that we're seeing just in terms of the trade talks and other factors that are influencing economic activity more globally. So we do think it's right to wonder if Europe may be headed towards a more pan-European recession and how much China trade is influencing that. But we also have China on this chart, and that's the orange line on the bottom left-hand panel. Yes, China did dip, but you'll notice that hook back up recently. We think what that could be is really an indication that some of the trade negotiations may end successfully. And so we are seeing a little bit of strength in some of at least that economy, which hopefully if that gets resolved, you might see that translate into a little bit better PMIs. Now, for context here, the panel on the right is also important. Most of the economies that we're talking about are really focused with the bulk of their output being more services oriented. And if you notice what's going on in services, you'll see that all of those lines are trending sideways, if you will, and well above 50. So I wouldn't say that those are very strong numbers, but again, we don't see that rolling over. And again, in fact, recent data would suggest that at a composite, some of those PMIs have picked up, as we've seen the services PMIs also pick up just a little bit. And so when we talk about recession being right around the door, there are things that we're watching, but the signals that we're seeing just aren't signaling that weakness in the economy such that we're going to get a recession in 2021 or 2020. Certainly possible, but it's not something that we're seeing today. Inflation, aha. We also get a lot of questions about inflation. So, I suppose one of the things I would say is just with the economy, there's a lot of signals that we monitor to understand what are the inflationary impulses and how might those be transmitted into an upward pressure on inflation. Right now, I think the markets and the central banks and most people would agree that we're not seeing a lot of inflation creeping into the economy today for a variety of reasons. And in fact, a lot of the indicators that we're seeing are a little bit soft, except for the one that I have behind me. And this, in our opinion, is really going to be the key thing to watch. And it potentially later down the road, depending on how the relationship between the orange line here, which is wage growth, and the blue line, which is productivity, depending on how those two things behave, I think is going to inform whether or not later in the year we might potentially get an upside surprise to the inflationary number. And the reason why is that orange line you can see is trending up. That's very good. It's good for wage growth. It's good for the economy. It's good to perpetuate the cycle that we're in. The labor market is very strong and doing really well right now. But what's kept that number in check is the blue line, which is the productivity number. So as long as we're able to have productivity also rising with the wage growth, that's okay. That should, prevent that wage growth from being transmitted with corporate margins being passed through ultimately to the consumer. Now, what we want to watch out for is if productivity rolls over, that's when we think you might be able to get an upside surprise on inflation. And at that point, that's when we're sort of wondering what the resolve of the Federal Reserve actually is going to be and whether or not they feel they need to take action. So that remains to be seen. We're not seeing a lot of that creeping in, but if there is one thing to watch, we would suggest that it's this relationship right here. It's not so much what we're seeing in the energy markets. Yes, that's important. China trade talks, yes, that's important. We think whether that's success or failure, either way, there's some inflationary impulses there. But this, in our opinion, is really the key to watch over the next 3 to 6 months in terms of how this relationship evolves and changes. Moving to the Fed balance sheet, I'm sure this is not news to anyone. This picture you've probably seen a few times at least, so I'm going to move quickly here. The key thing to point out here, and everyone in this room is well aware, is that the Fed has begun unwinding its balance sheet. Yay, good for them. We're going to roll that down to 3.4, 3.5 trillion. That's sort of the target. And interestingly enough, it's going to be the change in composition. The Fed said we're going to let the mortgages roll off. We're going to replace those with treasuries. But here's the key point. They're going to maintain the duration of that portfolio. That is a key statement in terms of their accommodative dovish stance. To maintain the duration of that portfolio, what that means is they're going to be buying assets out the curve. That's much more effective in being an accommodative Fed than just buying 30, 60, 90-day T-bills on the front end. So there's a lot going on in this chart. But more importantly, it's the Federal Reserve, when you broaden this out to global and you look at other central banks, and I think these are pretty important numbers. When you look at the Fed on the bottom there, in terms of the Fed balance sheet as a relationship or a percent of GDP, it's relatively small when you compare it to the ECB, which is at 40%, and certainly the BOJ at 101%. That is a large amount of money sitting on these central banks. So size of these balance sheets are important. Another really important factor is you haven't seen the ECB, nor have you seen the BOJ actually begin to unwind those balance sheets. And we think not only is that because of the size of the balance sheets, but more importantly, or at least equally of importance, is really the composition of the balance sheet. What I mean by that is if you look at the table, the Fed has been transacting in the most liquid assets in the world, US Treasury and agency-backed mortgages. If you compare that to the BOJ, they have had to infuse massive amounts of stimulus, hence the size of their balance sheet, but they're also transacting across a variety of risk assets. So not only JGBs, but they're also buying corporate bonds, they're buying stocks, they even entered the commodity markets. So when you think about the BOJ, for example, trying to unwind that balance sheet, not only is the size of this balance sheet a challenge, but you also have much higher probability of disrupting those markets if you were to go unwind your positions in corporate stocks and commodities than you would by unwinding agency mortgage-backed securities and US Treasuries. And so that's another key factor that we're watching, is not only the ability of these banks to unwind their balance sheet, but what are the repercussions of if and when they do enter those markets to let those assets roll off. So that'll be another key thing to watch. Not only the size, but it's the composition, and that matters a lot. So tying this back to the US Treasury rate and kind of what we think and some of the influences that are driving interest rates here domestically, specifically the US Treasury, but I think you could extrapolate this even more broadly to some of the corporate bond markets, just given sort of the yield spread versus rates available in other parts of the world. What we're showing here, at least when this is printed, you have the gray line is the US Treasury at 2.41%. And then we're comparing that to German Bunds. That's the blue line on the bottom. Because oftentimes you would hear, well, you've got foreign investors buying US assets because of that yield spread. Well, as we're all aware, I'm sure, the strength of the dollar has really made this relationship almost irrelevant. I think most people would argue that by the time you hedge out the currency risk, if you're a foreign investor, that spread relationship really collapses. And there's been a lot of chatter about this. However, what I think and what we think a lot of investors are missing here is how far off of the low the US is versus other global central banks. And so if you look at the German Bund, at the time of printing, the German Bund was only 11 basis points off its low. So if you think about wanting to own an asset that could protect portfolios in a risk-off scenario and really provide that cushion, I don't think German Bunds is where I would want to be, regardless of the cost of hedging. Whereas if you look at the US Treasury at 2.41%, again, when this was printed, you had a 100 basis point cushion that could rally before we even were within spitting distance of the low. And so that is incredibly powerful when you think about the second order derivative or dimension here that's not just the yield spread and what is the hedging cost, but if we're looking to protect assets in portfolios, what are some of the other factors that are driving demand for US assets, regardless of the strength or weakness of the US dollar? And we would point to this right here as one of the factors that's really influencing what's happening domestically in terms of our rates markets. So earlier I mentioned credit spreads are one of the things we look at when we're thinking about, are we seeing recessionary signals? And so what we're showing here is we have high yield corporate bond option adjusted spreads in blue, and we have investment grade corporate bond spreads in gray. I mean, what we would argue is sure, in December we had a gap higher. Those are far from distressed levels. And in fact, since December, you've seen an aggressive move narrower. So we would argue that certainly capital markets are working, and that credit is not signaling a recession. I'm getting the hook, I think. So I have one more slide, and then we're gonna be done. But one of the things we are watching, and again, I think it's something that you've probably heard a lot about, so I thought it was topical, is really the amount of BBB debt outstanding. So there's been a lot of papers written about this and sort of the systemic effect of the growing amount of BBB rated corporate debt within the universe. And sure, we acknowledge, if you look at that top left panel, there's a heck of a lot of this stuff out there. Over 50% of the corporate debt outstanding is BBB rated. Why is that a problem? Well, it's a problem if we hit the end of a credit cycle and a lot of this debt gets downgraded. And if you look at that bottom right-hand panel right there, you would see that the BBB rated debt, there's a line called IG corporates, there's a dark gray bar, and if you just compare that dark gray bar to the blue bar on the right, you would notice that the BBB portion of the investment grade market is dramatically bigger than the entire high yield universe. That could be a problem. So from that aspect, we would agree it's right to point out that there could be some systemic challenges. However, if you look at the top right panel, what we would argue is that it's important to understand the composition of the BBB space. And when we broke it down, you can see the yellow bars. Those are BBB minus. It's been fairly steady over this time period, and there hasn't been a lot of growth in the BBB minus, which are really the next closest to the precipice of potentially being downgraded. You've seen the most growth in BBB plus and what we would call BBB flat. Really, we think that's more of an indicator of corporations willing to lever up their balance sheet to either do M&A activity, potential share buybacks, or some other activity. But the point is that there are a few notches above, and we don't see it really being a systemic threat. In fact, we would argue that for an active bond manager, what this is much more idiosyncratic, which you might get some companies that have distress and some that don't, but just in terms of having a systemic effect of either credit ending or credit cycle or causing a recession, we're just not seeing it. So with that, I will leave the key takeaways on its own, just so that I can wrap it up here, but it's been a pleasure to be here today, and thank you so much.